Alright, in this video we're going to go over how to do a business combination with Goodwill and how to calculate that. So the problem reads, Astor Corp paid cash of $178,000 to acquire Zone Company's net assets on February 1st, 2011. The balance sheet data for the two companies and fair value information for Zone immediately before the business combination were as follows. So you can see here their numbers, and we'll come back to this as we start the problem. Here you have Astor's balance sheet items, their book value, and for Zone Company you have both the fair value and the book value. So for this we're mostly going to use fair value, just because that's how you do the accounting for this type of problem. So what's required here is these three things. We're going to give the journal entry recorded by Astor when it acquired Zone's net assets. We're going to prepare a balance sheet for Astor immediately after the acquisition. And we're going to give the journal entry to be recorded by Astor if it acquires all of Zone's common stock for $178,000. So, to do A, which is give the journal entry recorded by Astor when it acquired Zone's net assets, this is what you have. This is the journal entry right here, and cash is $20,000. If we go up here, we acquired cash of $20,000. Accounts receivable $35,000. Accounts receivable $35,000. Inventory is $50,000. Inventory is $50,000. Patents $60,000. Patents $60,000. So as you can see, the pattern here is it's just the fair value of Zone's net assets that Astor acquired, and these assets are debits because they're assets that Astor's gaining. Then you have buildings and equipment for $150,000, and then the Goodwill. So the way you calculate the Goodwill, and I put a note down here, this is the same amount. For Goodwill, you calculate this by taking the fair value of the consideration that was given, which was $178,000 in cash. Then you take the fair value of net assets acquired, which is $140,000, and that's the net assets, and then minus the two net liabilities of $55,000 and $125,000, which we see here. These are our net liabilities. So you would take these right here added up, which of course is just $315,000, and you would subtract these two numbers, and that leaves you with this $140,000. So the difference between the fair value of the consideration and the fair value of the net assets acquired is $140,000, or the difference in those two is $38,000. So that is your Goodwill number for this journal entry right here. Goodwill of $38,000. So then you have, it's the same down here, the net liabilities, accounts payable and notes payable of $55,000 and $120,000. Those are these same amounts right here, as you'll see. So then you come back down, the cash that you paid for $178,000, that completes the entry. So this is the whole journal entry right here for requirement A. Now to go to B, B says prepare a balance sheet for Astor immediately after the acquisition. So let's see what that looks like. Here's the balance sheet, and I've put notes in here as to why, what is what. So we start on the left side with the assets. cash of 82,000. The original 240,000 plus 20,000 acquired minus 178,000 paid for the combination leaves us with 82,000. So let's go up and look at this. So we started out with 240,000 right here. We acquired 20,000, so that would be 260,000. But the consideration that was paid for the net assets of Zone Company was 178,000. So that leaves you with, in the final balance sheet, 82,000. So if we go to accounts receivable, we had the original 140,000 plus the $35,000 fair value of the acquired accounts receivable. That equals 175,000. Inventory, 170,000 original plus 50,000 fair value of acquired inventory. That leaves you with 220,000. Patents, original 80,000 plus 60,000 of the acquired patents. That's 140. Buildings and equipment, the original 380 plus 150 of the acquired buildings and equipment. That leaves you with 530. Less the accumulated depreciation, that didn't change. And the Goodwill that we went over earlier, 38,000. So you're left with 995,000. So for the liabilities, under accounts payable, the original 85,000 plus 55,000 fair value of the acquired accounts payable leaves you with the 140,000. The notes payable, 150 original plus 120 of acquired notes payable. And then the common stock, this confuses some people. This stuff does not change. I mean, we just acquired the net assets. So common stock of 200, additional paid in capital of 160, retained earnings of 225. If we go up, you'll see that it is these same numbers right here. Whoops. These same numbers right here. We don't do anything with these numbers from Zone Company. And so the last C was give the journal entry to be recorded by Astor if it acquires all of Zone's common stock for 178,000. And that journal entry can be seen here. You would just debit investment in Zone Company. This would be the entry if Astor bought all of Zone's common shares for cash of 178,000, and of course the credit would be to cash for 178,000.